Good day to you and welcome to the course on entrepreneurship, Smpe 104. My name is Jude Ihanacho, your facilitator for this course. Entrepreneurship is a necessary ingredient for stimulating economic growth and providing employment opportunities in all societies. If you've already started a small business or you have it in mind to do so, you must take this course seriously, not just for the sake of passing your NIM exam, but to build your capacity for what lies ahead. In this course, we will discuss who an entrepreneur is, how he manages finance and marketing, how he develops business plan, how he administers the office and staff, and so on. We will also look at some institutions set up by government to assist SMEs, and then end by discussing the challenges faced by SMEs in Nigeria. This course is broken down into 3 parts and 7 modules, so you can follow up more easily. Part 1 has 2 modules made up of the concept of entrepreneurship and basic financial management for entrepreneurs. Part 2 covers another 2 modules, namely marketing management and developing a business plan. In Part 3, we shall look at 3 modules made up of office administration and personnel management, government and non-government institutional and support agencies, and lastly, the challenges of entrepreneurship in Nigeria. Once again, you are welcome. If you are ready, let's get right into it, starting with Part 1. In Part 1, Module 1, we will discuss the concept of entrepreneurship. I'd like to begin by saying that all over the world, entrepreneurs are building phenomenal businesses that are tackling societal problems and creating lots of jobs in the process. In Nigeria, you find young entrepreneurs in real estate, financial services, manufacturing, media, ICT, business consultancy, public relations, agriculture, fashion, just name it. So in this module, we will try to explain terms like enterprise, entrepreneur, and entrepreneurship. We will compare managers with entrepreneurs and find out the roles and functions of entrepreneurs in the society. We will also reveal the characteristics of successful entrepreneurs and then round up with the entrepreneurial process. That's talking about the steps involved in the journey to entrepreneurship. To start with, what is an enterprise? Enterprise in English. Enterprise is an English word. So in English, it connotes a project undertaking or to be undertaken, especially one that is so important, that is risky and difficult, or one that requires boldness or energy. However, in this context, it means a business formed and led by one or more persons to provide goods and services, create jobs, contribute to national income, and overall economic development. Let me take it again. It means a business formed and led by one or more persons to provide goods and services, create jobs, contribute to national income, and overall economic development. Now, can you give me some examples of enterprises? Think of any business formed and led by one or more persons to provide goods and services. I'll mention some examples. Microsoft, GT Bank, Jumia, Marvin Records, and so many successful businesses in various locations across the country. Note that the size does not really matter. Having understood what an enterprise is, it's easy to explain who an entrepreneur is. Adam Smith, the famous economist, tells us that an entrepreneur is a person who acts as an agent in transforming demand into supply. While Jean-Baptiste Cessay defines an entrepreneur as an economic agent who unites all means of production, land, labor, and capital, to produce a product. By selling the product in the market, he pays rent on land, wages per labor, interest on capital, and what remains is his profit. He shifts economic resources out of an area of lower productivity into an area of higher productivity and greater yield. That is Jean-Baptiste Cessay. Furthermore, John Stuart Mill tells us that an entrepreneur is a prime mover in the private enterprise. He is the fourth factor of production after land, labor, and capital. Another perspective is from Joseph Aloysius Schumpeter, who wrote that an entrepreneur is an innovator. The economy moves through leaps and bounds, and the prime mover is the entrepreneur through the process of creative destruction. The management expert Peter Drucker opined that an entrepreneur searches for change, responds to it, and exploits opportunities. Innovation is a specific tool of an entrepreneur to convert a source into a resource. So broadly speaking, entrepreneurship is the attitude of mind to seek opportunities, to take calculated risks, and derive benefits by setting up a venture. It comprises of numerous activities involved in conception, creation, and running an enterprise. It involves a fusion of capital, technology, and human talent. Let's try to distinguish between a manager and an entrepreneur. A manager is usually an employee, not an owner of an enterprise. He is the one that is responsible for the management and administration of a group of people or a department of an organization. His daily routine is to manage employees and to ensure the organization runs smoothly. Now, on the other hand, an entrepreneur is essentially an initiator of the organization and the leader of all employees, including the manager. We have brought up some key features to differentiate a manager from an entrepreneur. The first has to do with primary motives. The primary motive or driving force of a manager is corporate reward, such as salary, bonuses, and other perquisites attached to his position as a manager. An entrepreneur is driven by freedom, the freedom to choose his goals and actions. He is also driven by the fact that he is self-reliant. Whatever he achieves is as a result of his efforts and sweat. Now, the second is position or qualification. A lot of managers are formally educated in their various fields, while many entrepreneurs do not have formal education on their enterprises. Take, for instance, a blogger who did not study mass communication. Another instance, the owner of a supermarket who did not study business admin or any commercial course. Now, the third difference is in terms of income stream. A manager has steady salary, while an entrepreneur's income is uncertain. Lastly, the attention of a manager is primarily on internal activities, while that of the entrepreneur is on external changes in the marketplace. Right, entrepreneurs play very important roles in the society. Some of them are partnering with governments to upgrade the quality of life and level of development in the country, promotion of local and indigenous technology, promotion of domestic productivity and production. They also help in reducing national trade imbalance and currency weakness. They develop local management and business skills when they teach other upcoming entrepreneurs. They exploit local raw materials and production methodology. They also reduce societal imbalance problems. Let's look at the functions of an entrepreneur. An entrepreneur performs a lot of functions. He decides on what to produce or the business to operate. He or she is an innovator who develops a new product, market, or way of doing things. He searches for and develops business opportunities and ideas, bears the risk of a business operation, spearheads the setting up of a business, finds means of making profit from a business. Furthermore, he acquires and organizes capital and other resources to run a business. He motivates and uses human resources to work optimally and coordinates all aspects of a business to run it well. Owning a business isn't for everyone. The stress and hard work that comes with it makes many people unwilling to dive in. It takes a special kind of person to be an entrepreneur, to generate an idea and put that idea into action. That is why we must learn the characteristics of successful entrepreneurs. These entrepreneurs are usually visionary, innovative. They have great passion for the business and are willing to take risks. They have tenacity, organizational ability, and customer focus. They invest in knowledge acquisition. They possess human relation skills, and so on. But generally speaking, as an entrepreneur, you may not have the luxury of hiring a support staff initially. Therefore, you end up wearing several different hats, including being a secretary, being the accountant or bookkeeper, and so on. You must know how to adapt to unfamiliar situations. If your business requires that you learn how to build a website or send an invoice, please learn. Please learn. Whatever it takes, entrepreneurs are ready and willing. They always approach things with an open mind and are willing to change course if they need to. If you possess these characteristics, I can tell you that you make a very good entrepreneur. Let's look at the process of entrepreneurial development. It's like saying the journey of an entrepreneur. There are 5 phases, namely self-discovery, identification and evaluation of opportunity, planning for resources, venture commencement and launch, and finally, stability, and growth. The interests and skills of the entrepreneur must fit with the business model. The market opportunity must fit with the product concept. There should be sufficient resources, including financial, material, and human resources. There has to be adequate preparation for commencement and launch. But I will discuss each stage in more detail. Self-discovery is the initial stage. I sincerely believe that the journey into entrepreneurship begins with knowing who you are, your passion, your life goals, your definition of success in life. Realizing how your business will enable you to experience what's most important to you. I'll use myself as an example. For as long as I can remember, my joy comes from educating people, sharing knowledge, making employees and managers become more productive. These I have discovered about myself. So my enterprise is training. It fits well with my passion. Every potential entrepreneur must make out time for self-discovery. Now let me ask you, how would you describe yourself? And what type of business fits into your passion? The second phase in the journey is identification and evaluation of opportunity. There are a lot of business opportunities in our environment. If you keep your eyes open, it will amaze you the number of problems that people need solved. Is it where to get neat and affordable meals? Is it how to deliver items to their online customers? Is it how to package a wedding ceremony creatively? Is it how to get information about specialist doctors? Is it who will guide them to burn excess fat? So many. Is it how to get steady supply of eggs for their confectionery business? You need to identify and solve a real problem for real people. Furthermore, you must evaluate the viability of such opportunity. That is, whether or not you have the knowledge, the skills, and the experience, and also the passion to solve that problem. If you have all this, then you can make a living servicing that need. The third phase, phase 3, is planning for resources. What will it take to make that product or deliver that service? That's the question here. The resources you need to start a business can be broken into 4 broad categories: financial, human, material, and physical resources. All these will form part of your business plan. We'll look at a business plan in detail when we get to part 2, module 4. The fourth phase is venture commencement and launch. But before this time, you must have gathered all the resources and information you need to start your business. You must have known what product or services to focus on, who your potential customers are, that is your target market, and also your distribution channel. Then you are ready to open shop and launch into the market. You must have a good market penetration strategy. Of course, you should be mindful of competition, as existing service providers will try to match your offering immediately. So you must be flexible and nimble enough to change strategy if need be. The important thing is not to be discouraged, but to go ahead and ensure you journey into the next phase, that is stability and growth. So after having done the initial activities in developing your product or service, you need to develop a chain of activities to regularly produce and provide the product or service in the most cost-effective way. That means making sure there be sufficient resources to produce and provide the product or service to your customers, and also ensuring the product or service exceeds the customer's expectations. As your customers demand more and more of your products and services, and as you notice more opportunities to serve more of your current and new customers, you will start thinking about how to grow your business. Growth has to do with ensuring that you broaden your scope. It has to be done very carefully. Otherwise, you can end up chewing more than you can swallow. Module 2. This module introduces you to the field of finance. One of the resources an entrepreneur plans for and controls is money. You cannot control money if you don't get mastery of its inflows and applications. So finance is central in decision making. That is why this module is highly recommended for entrepreneurs. Definition of financial management. Financial management has been defined in various ways. A simple definition is that it's the process of making financial decisions with the ultimate objective of maximizing the shareholders' wealth. CIMA, that is Chartered Institute of Management Accountants, defines financial management as the identification of the possible strategies capable of maximizing an entity's net present value, the allocation of scarce resources among competing opportunities, and the implementation and monitoring of the chosen strategy so as to achieve stated. Financial management is better understood when you appreciate the objectives of a business or the objectives of financial management itself. Profit maximization is one of them. Profit maximization is the ability of the company to operate efficiently to produce maximum output with limited input, or to produce the same output using much lesser input. So it becomes the most crucial goal of a company to survive and grow in the current cutthroat competitive landscape of the business environment. The most basic model of a firm assumes that firms wish to maximize their profit, and they will do so by increasing revenue. Remember, revenue is price and quantity, and also to reduce costs. Many firms like to do both simultaneously, increase revenue as well as reduce costs. So that is what profit maximization entails. And the higher profits enable a firm to pay higher wages and also to give more dividends to shareholders. There are many other objectives, such as corporate image, increasing market share, and so on. Okay, so this can be a way also of maximizing long-term profit. Let's look at wealth maximization. Wealth maximization as an objective of a business is the ability of a company to increase the value of its stock for all the stakeholders. It's a long-term goal and involves multiple external factors like sales, products, services, market share, and so on. A firm may not be motivated by money, but may have financial objectives, such as providing good welfare package for stakeholders, improving competitiveness, and also minimizing. There are three key decision areas in finance, namely investment decision, financing decision, and dividend decision. The first, that is the investment decision, tells us how funds will be invested. And the rule is to invest in the most profitable projects or assets. Investment decision is an area that deals with identifying and appraising the viability of projects an organization wishes to embark on. It may be to acquire fixed assets, open a new branch, buy a robust software, and so on. So the manager must appraise or analyze such investment or such potential investment to ensure that it generates enough revenue to offset the cost of acquisition and also contribute to the profitability of the organization. So many techniques are used to forecast how viable a project is. The popular ones are the payback period, where you judge the viability of a project by how long it will take for cash flows generated by the project to be equal to the initial cost of the project. So it's in time period. The shorter the payback period, the more desirable the project is. Another way of evaluating a project is the accounting rate of return, where you judge the viability of a project by how long it will take for accounting profit generated by the project to be equal to the initial cost of the project. Note, accounting profit. So you judge the viability of a project under accounting rate of return by how long it will take for the accounting profit generated by the project to be equal to the initial cost of the project. The third way of evaluating a project is the net present value, or NPV for short, where you judge the viability of a project by how much the discounted inflows generated by the project surpass the initial cost of the project. I would like you to read up these methods, especially the NPV, the net present value, so you'll appreciate the concept of time value of money. Yeah, the second decision area is financing decision, which is concerned with how funds are sourced. It deals with the determination of capital structure. Every financial manager must know the various sources of finance in order to decide which combination to go for. The decision on capital structure is usually is to make a choice between equity and debt, or a combination of both. The third decision area is dividend decision making, where a finance manager decides whether to pay dividend or to plow back the gain. And if dividend should be paid, how much? Sources of business finance. The sources of business finance can be grouped into three classifications. Okay, now this classification is not cast on stone. The first is the basic classification into debt or equity. Funds can be borrowed, that is debt, or sourced from the owner's savings, and that is equity. The second is in terms of maturity. That's the second classification, is in terms of maturity period. Funds could be short-term, medium-term, or long-term, depending on their maturity. Maturity has to do with the time frame you can use the money. The third is according to the provider of funds. That may include close relatives, informal financial groups like money contributions amongst members of certain societies, and lastly, financial institutions. Time value of money. I love this concept because of the common saying that time is money, which is very true. Time value of money simply means that the value of 1 naira today will not be the same in the nearest future. So 1 naira expected in future is not the same. It's not even equivalent to 1 naira held today. I'm sure you'll agree with me. So a naira received today is worth more to anybody than a naira, the same naira, receivable at any other time in future. This can be due to factors such as interest. Okay, that is the first major factor, interest, because the money you received today can be invested today to yield interest tomorrow. Another factor is uncertainty. Uncertainty. The business environment becomes more uncertain as you project into the days and years. So tomorrow is not assured. So as my people say, a bird in hand is worth 20 in the bush. Inflation is another key factor when you think of time value of money. In an inflationary economy such as ours, the longer you wait to receive money, the lower the purchasing power of that money. Of course, due to the impact of inflation. There is also the issue of subjective time preference, where people just want to hold their money now as against any time in the future for no objective reason. So in trying to create wealth for your organization, you may invest your excess liquidity in instruments that yield interest. Therefore, it's important to understand how money grows and how interest payments are computed. That takes us to the mathematics of finance. There are two basic methods of interest computation: simple interest and compound interest. Let's look at each of them briefly. Simple interest assumes that only the principal is reinvested every year. Only the principal sum is reinvested every year. All accumulated interests received are excluded from the reinvested amount. So you are simply rolling over the principal sum only. The formula for the future value, that is how much you get in future, is SI equal to P into 1 plus RT. SI meaning simple interest, P is the principal, R is the rate, and T is the time period. Let's work out this illustration. Mazi Okon recently collected his gratuity. He has decided to invest 500K at a simple interest of 5% per annum. Calculate the interest due to him at the end of 5 years. Can you work that out? Now, the principal is 500,000. Rate is 5%, while time is 5 years. So when you multiply out, simply you will get 125,000. On the other hand, compound interest assumes that both the principal and accumulated interest received are reinvested every year. all accumulated interest received are added to the principal or to the reinvested amount. So you are rolling over the principal plus the interest. The formula for this future value is principal into 1 plus the rate raised to power number of years. So using the Ahmed illustration to compute the compound interest and the future value of the investment, the principal is 200,000, rate is 10%, while time is 4 years. Then when you multiply out, you get 292,820. Discounting. Now, when you want to know today's worth of an amount receivable in future, today's value or worth of an amount receivable sometime in the future, you simply bring that amount receivable in future back to this day. What is the value of that amount, that future amount today? So the process of bringing back the future amount to present value is known as discounting. So it's actually the opposite of compounding. Compounding is moving today's amount forward to determine the value at a future date. Now let's illustrate discounting with Kikelomo, who has a liability of 90,531 naira 97 kobo, a liability which she must pay in 4 years' time. So how much must she invest today to have this sum in 4 years? Assuming the investment will earn 16% interest compounded annually. So the problem is to know how much 90,531.97 repayable in 4 years' time is worth today. So applying the formula, P is 90,531 divided by 1 plus 0.16 raised to the power 4, 4 years. And the answer you get is 1,000 naira. Now let's look at basic financial accounting. Every entrepreneur needs basic accounting knowledge to be able to understand his business better, to take better decisions, and also communicate more effectively with stakeholders. So bookkeeping is the part of accounting concerned with recording financial data and transactions in the accounting books. The users of accounting information are managers, shareholders, prospective investors, financial institutions, suppliers, customers, and so on. See, when you hear that a transaction has been done, it means that an event with financial implication has occurred. Simple. So these transactions are recorded in books called accounts. So accounts can be maintained in hard books, like so many people still do till tomorrow, or accounting software. So the double entry system, double entry bookkeeping, is a system of recorded transactions in the books of account. This is how it works. Each transaction has double effect and should be recorded as such, debit and credit. So the double effect is reflected in terms of debit and credit. So each transaction has a debit side and a credit side. Debit is for increase in assets and expenses, or decrease in liabilities, equity, and income. I repeat, debit is for increase in assets and expenses or decrease in liabilities, equity, and income. So when assets increase, that increment is a debit, is debited. Okay? When liabilities decrease, that is a debit as well. When equity or income decrease, that is also a debit. Now let's look at the credit side. Credit is for increase in income. Increase in income is for increase in liabilities, increase in equity, and of course, decrease in assets and expenses. So you credit a transaction when there is an increase in income, liabilities, or equity. Or if there is a decrease in assets and expenses. Okay, so I recommend that you go and read through the double entry accounting system. It will have a broad view so that when your accountant tells you, I've debited the transaction, I've credited that transaction, you'll understand the meaning. Now, all books of accounts are summarized in the financial statements. So the financial statements are reports that quantify the financial strength, performance, and liquidity of a company. The basic types of financial statements are: one, the statement of financial position, or balance sheet, as it is traditionally called. The balance sheet. So this is a statement showing the assets, liabilities, and equity of a business at a point in time. At a point in time. As at 31st December 2019. That is a point in time. The second one, the second financial statement, is the income statement or statement of comprehensive income. It shows the revenue earned and the expenses incurred that results in a profit or loss situation. The third financial statement is the cash flow statement, which shows all cash receipts and all cash payments within a given period. Now, the fourth one is statement of changes in equity, which shows how equity, the owner's equity, has changed over the period. Of course, time will not permit us to show and explain these statements line by line. But the onus is on you as an aspiring entrepreneur to study them in depth. Thank you so much. I'll see you again in part 2 of the course on entrepreneurship to discuss marketing, management, and then development